Something massive is happening behind the closed doors of Wall Street, and it's about to change the financial landscape of 2026 forever. While most people are distracted by the holiday season, the world's largest silver manipulator, JP Morgan, has finally hit a wall they cannot climb over. The data coming out of the COMEX and LBMA vaults is showing a level of physical depletion we haven't seen in decades. This isn't just a market fluctuation, it is a systemic failure. To understand why JP Morgan is trapped, we must look at the registered silver inventory. For years, these banks maintained a massive buffer of physical metal to settle their paper shorts. But according to the latest exchange reports, physical silver is moving out of warehouses at an alarming rate. As of late December, the ratio of paper contracts to actual physical ounces has reached a breaking point. There are now over 400 paper ounces for every single ounce of physical silver available. Why is January the month of reckoning? Every year, the first quarter represents a massive rollover period for futures contracts. Large industrial buyers, particularly from the tech and green energy sectors, are no longer settling for cash. They are demanding physical delivery. When these contracts expire in January, JP Morgan and other bullion banks must produce the metal. If the vaults are empty, as the data suggests, we are looking at a potential force majeure or a technical default event. The trap was set when China announced its new restrictions on silver exports earlier this year. Historically, the West relied on the East to balance the supply deficit. But with China prioritizing its own domestic solar and AI chip manufacturing, the supply chain has snapped. JP Morgan can no longer lease silver from international partners to cover their short positions. They are now competing with sovereign nations for a dwindling supply of silver bars, and the math simply doesn't add up. Unlike the 1980 Hunt Brothers era, this silver squeeze is driven by industrial necessity, not just speculation. Every high-end AI server, every electric vehicle, and every solar panel requires a specific amount of physical silver. These manufacturers don't care about the paper price on a screen. They need the physical atoms to keep their factories running. This relentless industrial demand has created a floor under the silver price that the big banks can no longer push down. For decades, the price of silver has been suppressed through high-frequency trading and naked short selling. But a paper trap only works as long as nobody asks for the underlying asset. Now, institutional investors are losing faith in the banking system's ability to deliver. We are seeing a massive shift of capital from unallocated accounts into private vaults. When the smartest money in the room starts moving to physical, you know the paper game is almost over. JP Morgan has historically used silver leasing to hide the true state of their reserves. They essentially borrow silver from central banks and sell it into the market to suppress the price. However, our research shows that the lease rates have spiked to multi-year highs. This indicates that there is no metal left to borrow. The lease loop is broken. Without the ability to lease more metal, JP Morgan's short position is exposed to the full volatility of the market. The size of the short position held by the big four banks is estimated to be larger than the total annual global mine production. Think about that. They have sold more silver than the entire world can mine in a year. In any other market, this would be illegal, but in the precious metals market, it's been the status quo. However, a short squeeze of this magnitude becomes inevitable when supply hits zero. January 2026 is looking like that 0 hour. The US government's push for renewable energy is ironically the biggest threat to the bank's silver manipulation. The massive subsidies for solar farms have created a black hole for silver. Silver is the most conductive metal on Earth, and there is no cheap substitute for it in high-efficiency cells. As US solar capacity doubles, the industrial drain on COMEX silver will accelerate. JP Morgan is essentially fighting against the entire global energy transition, a battle they cannot win. We must also consider the broader banking environment. With interest rates remaining volatile and the commercial real estate bubble leaking, banks like JP Morgan are tightening their risk profiles. They cannot afford to maintain massive, losing short positions on silver while their other assets are under pressure. The cost of carrying these shorts is becoming too expensive. The rational move for the bank's risk department is to cover their positions, which will only ignite the rocket fuel. The geopolitical shift cannot be ignored. The BRICS nations are actively working on a commodity-backed settlement system. By accumulating gold and silver, they are draining the Western exchanges of their leverage. If Russia or India decides to launch a silver-backed trade token, the demand for physical silver would explode overnight. JP Morgan's short position is a bet on the continued dominance of the US dollar, a bet that looks increasingly risky as we head into the new year. History tells us that when a commodity market moves from surplus to structural deficit, the price adjustment is never gradual, it is violent. We saw this with nickel on the LME, where the exchange had to literally cancel trades to save the banks. But silver is a much larger and more global market. Canceling silver trades would destroy the credibility of the COMEX forever. JP Morgan knows this. They are trapped between a market collapse and a price explosion. In economics, a Minsky moment is a sudden collapse of asset values after a long period of speculation or unsustainable debt. For the silver market, the debt is the mountain of paper silver contracts. The moment the market realizes the paper silver cannot be exchanged for physical silver, the confidence will vanish. This is the definition of a trap. Once the exit door is too small for the crowd, the panic begins. January is the likely threshold for this realization. If you look at the LBMA data from London, the unencumbered silver, metal not already owned by ETFs, is at record lows. Most of the silver sitting in these vaults is already spoken for by investors in funds like SLV. If a major industrial buyer or a sovereign wealth fund tries to buy 50 million ounces of physical silver today, they would likely be told to wait months. This lack of available for sale metal is the final nail in the coffin. It's not just the big players. Retail investors are also waking up. The premiums on physical silver coins and bars are starting to creep up again. In the US, the silver stackers movement has removed millions of ounces from the market and put them into diamond hands. Unlike institutional traders, retail stackers don't sell when the price goes up. They buy more. This reduces the float of silver that banks can use to manipulate the daily price. What happens if JP Morgan actually defaults on a delivery? In the futures market, a failure to deliver is the ultimate black swan. It would trigger a cascade of lawsuits and a total loss of trust in the financial system. To avoid this, the banks will be forced to bid against each other to find any available physical metal. This scramble for silver is what will drive the price from $70 to $100 and beyond in a matter of weeks. Let's talk about AI. The massive data centers being built by companies like Microsoft and Google require immense amounts of silver for high-speed circuitry and power components. These companies have infinite cash and zero tolerance for supply chain delays. If they see a silver shortage coming, they will buy up entire mines to secure their future. JP Morgan is shorting a metal that the world's most powerful companies desperately need for their survival. It's an impossible position. As we cross the threshold into January, watch the delivery notices. If we see a surge in notices that the banks are struggling to fulfill, the market will react instantly. This is the period where short covering becomes short squeezing. The banks will have to buy back their paper shorts at any price to avoid a total default. This is the trap snapping shut. The price action in the first 2 weeks of January will be the most critical of our lifetime. For the average investor, this isn't about getting rich quick, it's about wealth protection. When the world's largest banks are trapped in a short position they can't cover, the underlying asset becomes the safest place to be. Physical silver is one of the few assets that has no counterparty risk. It doesn't require a bank's promise to have value. In an era of bank defaults and paper manipulation, if you don't hold it, you don't own it, has never been truer. The evidence is clear, the math is undeniable, and the clock is ticking. JP Morgan has played a dangerous game with the silver market for decades, but they have finally run out of physical metal to back up their paper lies. As the January default window opens, the global silver market is about to enter a period of unprecedented volatility. Position yourself now, because once the great silver squeeze truly begins, there will be no second chances to get in at these prices.